Hi everyone, I'm Toby Turtle, the official mascot of STO Summit Spring 2025. We're excited to share the recorded sessions from the world's leading summit on security tokens and real-world assets. Now, let's dive into today's talk from one of our global leaders. Hey Augustine, over to you.
Please welcome Kyle Sonlin, CEO of Global Settlement Network, on how tokenization quantifies financial benefit.
Thank you, Augustine, for having me. It's an honor to be here and to represent at the ISTA. I've really enjoyed the discussions thus far, and I'm here to help round out the final conversations because we have, I think one or two panels left. I think I'd do a panel after this, but I figured I'd kick off a keynote talking about quantifying the opportunity of tokenization. And so a little bit of background on myself is my name's Kyle Sonlin. As you can see, I work very closely with Jason at STM and was a co-founder of that company, and also have been working on a new project called Global Settlement, where our focus is actually really driving the connective tissue between a lot of these banking institutions, as well as the issuers and everybody in between. I'm actually a bestseller of a book called Blockchain Explained, Your Ultimate Guide to the Financial Tokenization or Tokenization of Finance. And our goal there was to figure out, okay, what are the business use cases of tokenization? Why would somebody want to actually tokenize? And so I think that the idea of tokenizing or using blockchain technology as a distribution tool is certainly the most attractive component for financial institutions. When we're talking about distribution, we're talking about how you're going to get buyers. How do you capture new buyers into this opportunity? And this sounds great on the surface. It sounds like, okay, I'm a company, I'm looking to fundraise. This is a new way that I can access the crowd. But historically, that has been a difficult use case to actually make happen in reality. And so a lot of what I've spent time focusing on with many of the industry players that have worked in the security token and blockchain ecosystem for so long is really trying to understand, how do we quantify the benefits of using this technology outside of marketing or hype or something like that that looks or sounds good. And so with Global Settlement, we've been working on a couple of different private credit use cases that I think are very interesting. And perhaps I can use one of those use cases to demonstrate how you can actually quantify these opportunities. And so I actually had opportunities to meet with the KRX last year during Korea Blockchain Week and discuss to them why it's valuable to tokenize. And let's start with just optimizing for currency. So in high frequency trading situations, when you have a lot of transactions that are going back and forth, what we've realized, certainly over the last decade or so, if not more than a decade, is that quantitative modeling is just way faster at trading than the human is at making decisions. And so every fund, every large institution now has basically fully AI renovated their trading strategies, where they feed all kinds of data into these models and then make investment decisions based off of it. And this is, I think, a tremendous opportunity because it reduces the cost of having individuals doing those things. It also generally actually performs better than what you see in the traditional markets. And I think that that's a wonderful component of this technology. The problem is for the vendors that are operating, the exchanges in between, the brokers, all of the government entities and regulating bodies that are in between these individuals, it's really hard to keep up. And that's only going to continue with pace. We're seeing high frequency trading running off the hook. And now it's not only happening within underlying economies, now we have the global economy to worry about. And so with a lot of these regulators, when you have a syndication, when you're bringing together counterparties from all different international jurisdictions, it can become an incredibly burdensome process to manage not only the money moving from one place to another, the speed at which all of the counterparties are trying to push through this information. Because the market's moving so quickly, there is, I think, a natural time window for deals to actually get done. And so you don't really want to be in the way of what's going on. But at the same time, there are so many components that you need to manage. And that not only creates lag time and delay, but it also presents the first key risk factor, which is hacking and security. And so as we start to release quantitative models that are super high frequency, we have already begun with the AI age of seeing how data centers and processing power are the new gold or oil or real estate in different jurisdictions, because the speed at which these systems can move directly translates to opportunity cost in terms of everything from the time that it takes to the use case that I've spent a lot of time thinking about, which is turnover rate. And so to use an example that Global Settlement has been working on in a slightly different angle is the commodities sector. In the commodities sector, you have many large players. It's a highly, I would say, conglomerized industry, meaning that the largest firms suck up a lot of market share. They often acquire the smaller firms and roll those systems up into larger firms. And so what we see is a company like, let's say, Trafigura, one of the largest in the world. They did $250 billion in revenue last year as a trading desk for all kinds of commodities, whether that's gold, oil, agriculture, and many things like that. Now, most of our developed nations around the world import a lot of these resources, whether it's for energy consumption, whether it's for jewelry and other kinds of consumption. Certainly now there's a huge hardware race with chips. You've got silicon and lithium demands, cobalt demands, gold demands, and many other types of graphene products alongside hundreds of other elements at different sizes. Many of these resources are not mined or farmed or harvested in the jurisdictions or in the countries where the products are created, and they probably aren't created in the places where those products are consumed or purchased. So because of that, it is an incredibly large market. It is a multi-trillion-dollar market per year in revenue, let alone multi-hundred trillion in trading volumes on just the purely assets moving from one place to another. In fact, it is probably the main driver of GDP for many of the countries around the world. And yet, despite that, it is still underutilized because of the fact that many of the countries, as we discussed in our analogy, that have the natural resources that the rest of the world wants, do not have a robust financial ecosystem. And so if you're moving a ACH transfer of a bank wire from one bank, let's say where I am in Miami, Florida, or in New York City, and you're trying to move that to a regional bank in Western Africa, let's say Guinea, you're trying to move that capital into Guinea in order to purchase gold from a bunch of gold miners and move that gold into a third location, let's say Dubai, into StoneX, and sell that gold and make a spread on that transaction. That's essentially what a large trading desk might do. Now, the problem is actually not moving that product in the same way that in a lot of cases of moving debt structures, private credit structures, and treasury products, let alone stocks and securities, like we've seen many companies looking to do, moving the actual product oftentimes is not the hard part. It's managing the financial compliance of sending that capital from one place to another. So in our example, like in moving gold from one place to another, it might take 36 hours to 48 hours, a day and a half to 2 days to actually move the product from that Western African nation into Dubai, into our purchaser. The problem would be that it would take 1 to 2 weeks potentially to actually get the money from one bank into the other. That's because it moves from a lot of different institutions from one place to another. And then even when it gets to that local regional bank, it's incredibly hard for that issuer to receive that payout, because that small regional bank may not actually have the infrastructure to support the cash itself as it gets delivered. And so this idea of working with atomic swaps and moving the capital, moving the resources from one issuer to another is a huge opportunity. Now, in my gold example, because that's something that I've been working on directly, I can specifically denote that with a stablecoin, just moving the stablecoin from the purchaser to the end supplier, they receive that capital immediately. So if it were to take 2 weeks for that bank wire to hit, for a traditional example, but it only takes 48 hours for the actual product to move from one place to another, that means you're talking about 7 times more trades that you could do. Because instead of me having to wait 2 whole weeks to get that stable coin into that, or excuse me, not the stable coin, instead of having to wait 2 weeks to get that bank wire via ACH into that underlying issuer, I can make that happen instantly. Now I can move that transaction, get the capital back on the sale of the product when it lands in Dubai, and I can then redo the same exact process again. And I can do that 7 times in the speed that it might take a traditional bank wire. In this way, we've actually 7x'd our turnover. That means for every $1, I make 7 times as much as your typical provider. Because of that, that allows me to either offer competitive rates in the market and make 7 times as much profit, or that allows me to take significantly lower rates than the traditional example and outcompete. Because now I can offer cheaper rates to acquire more capital and to acquire that business share, or operate a more profitable business, which then will subsidize my additional distribution strategies. It also allows me to scale at a significantly larger clip, because now I have resources to be able to deploy into that scaled infrastructure, as well as the fact that with tokenization, the size of the asset is pretty much irrelevant from a technological standpoint. There's not going to be any additional hurdles when you add an extra zero from a technical perspective. Obviously, some of those things regionally, locally, and internationally, some of those jurisdictional compliance standards may still apply, and you have to work through all of those things as you go. The point of this analogy, though, is not only are we capitalizing on this opportunity to move stablecoins as a payment infrastructure, that is a key bottleneck right now. I don't know if anybody that's listening or may listen to this in the future has experienced some of the issues with escrow solutions, has experienced issues with finding banking partners. Using stablecoins alone is a killer use case in optimizing capital markets opportunities. And we've been able to quantify that, particularly with our turnover in our business. We've built an existing business that operates trade finance commodities transactions. And we're specifically able to model, and I'm happy to share if anybody wants to reach out, we have financial models that are dictating where these real quantifiable benefits are. You can see it in the financial model. The real savings that come from using a stablecoin because of that turnover. And so the point of this conversation and the point of me wanting to sit down and discuss a keynote here is for anybody that's looking to tokenize their assets, the key in understanding, should I tokenize or why? To answer the question of why should I tokenize, the answer needs to be, in my opinion, because there is a quantifiable benefit. It either reduces your cost of capital, which means that the opportunity to bring in capital partners is lower. This is what we've seen from some of the tokenized treasury funds, right? BlackRock, Franklin Templeton, Wisdom Tree. They've seen that there are billions of dollars that are on chain, that are in the crypto markets. A lot of them are staked, which means people take their crypto, they stake it and get rewards. But what happens is you have a lot of these foundations, these decentralized organizations with hundreds of millions or billions of dollars of float. That is capital that's sitting in these staked pools. And their job is to figure out how to actually get a yield for their underlying shareholders. And so we've seen a lot of these staking protocols desperately looking for yield generation strategies, specifically yield generation strategies that do not include seigniorage. Seigniorage is defined as the minting of new currency. You see this all the time in crypto, where they allow you to stake your crypto, and in exchange for giving them your money, they give you a different token as a reward, a governance token or something along those lines. And while that's nice, that system has proven to be really, really difficult to do at scale. And so instead, a lot of these decentralized managers sit there and say, look, we'd rather give this money to BlackRock to give us 4% yield, and at least we can offer 4% yield to our customers. So BlackRock and WisdomTree and many of these funds say, okay, this is a distribution strategy for us to scale up our treasury products to the tune of close to $10 billion already in additional capital that they had not already acquired. So from their perspective, it is a cost of capital acquisition calculation. They think it's cheaper for them to go through the blockchain crypto markets to acquire their resources than it would be to target their existing customer bases. That is the calculation that they had done methodically and modeled out programmatically, but it's also been proven now, which is helpful. So using existing comps is a very useful tool here. On the other side, there is the cost of capital benefits of it's cheaper to acquire cost of capital. You also could argue that it increases your top of funnel. It increases your revenue. In my example, discussing the turnover rate, that is an opportunity to make more revenue. Perhaps it also allows me to reduce my costs, but at the very least, it allowed me to do things faster. And since I could do the process faster, I could then deploy my capital a second time faster than I would have in a traditional business model using the same industry. And so what you need to do as a token issuer is to figure out, how can I quantify the material benefits of tokenizing my asset and tokenizing the capital markets process? Does this allow me to use AI to automate some of the systems? Right now, we're building NFTs that track the loan agreements and draw against insurance policies programmatically. Now, it would be really tough to do this if we didn't have blockchain secured data. I personally don't know if I trust self-executing code to operate on a non-encrypted, non-blockchain server because of the fact that is a hacked vulnerability point. So instead, we built out our own network to do so, which allows for AI agents to execute on contracts in the capital markets transactional system. For us, that is a demonstrative benefit in cost savings as opposed to cost benefits or cost acquisition savings in our example of distribution, which is also different than making more money through something like a turnover rate, which would be increasing that top line revenue. So there's increasing top line revenue, there's decreasing the cost of capital acquisition, or there's reducing the costs associated with the process. I think this is a really important discussion to have because we all have heard people talking about efficiencies of tokenization and the benefits and how this is so wonderful. But at the end of the day, we are financial services professionals. We are capital markets experts. And if you are putting together a deal to go to LPs, to go to investors and pitch them on an opportunity, at the end of the day, anything that does not reduce the cost of capital or improve the rate of return is irrelevant for an LP. Unless you find an evangelist, somebody that just cares about the technology, or a charity, a philanthropist that just wants to give extra money because they want this to be the future. But if you're finding a real investor that really focuses on return, a real capitalist investor, the main focuses for them are going to be what I just described. At the end of the day, it's going to come down to, what's the rate of return? Can you prove to me that this will increase my rate of return? Or put it another way, you could potentially argue that if this could reduce the lockup period or increase the actual return from how fast you return the capital to them. But those are the two priority points for an LP, for an investor. And at the end of the day, if you're an issuer, that's all you care about. It's how am I going to get my project fundraised? So with the tokenization component, the main focuses are always about how to reduce the cost of capital, increase the opportunities by using tokenization. There's also a whole separate discussion on post-issuance services around what it means to be able to align shareholders and customers, how if somebody self-custodies their tokens, they can get benefits across the asset classes and how maybe increased benefits after investing maybe does increase the rate of return. But that's a totally separate conversation for another day. So I really want to thank Augustine so much for having me here. I'm going to be transitioning into a panel coming up here soon, which I can't wait to have. But I know we have one last speech from Kim Hee, who's going to be coming in here very, very soon. So Augustine, I really appreciate the time. Thank you for allowing me to expand upon something that matters so much to me, which is quantifying those benefits. And if you want to learn more, go to globalsettlement.com. You can also find me, Kyle Sonlin, on LinkedIn or kyle@globalsettlement.com to learn more about the process that we're building in revolutionizing the SWIFT network. Our goal is to disintermediate and move away from ACH transfers, move away from bank transfers using native stablecoins that connect cross-chain, because we just don't believe in the bridging solutions. We don't believe in these segmented, siloed blockchains. So we are building an interoperable protocol mainly focused on capital markets transactions. If you are a commodities issuer, if you are a stablecoin issuer, if you're anybody looking to tokenize and bring in capital into your deals, reach out to me and I would love to learn more. So Augustine, I can kick it back to you if you're ready.
Thanks for joining us at STO Summit Spring 2025. Stay curious, stay connected, and remember, the future is tokenized.